Hey, Jason, welcome to the show.
Hi, Brad. Glad to be on the show.
So, can you give everybody kind of your background and how you got into the position where you are today?
Sure, absolutely. Well, I actually started out as an academic in the university, but thought, hey, all these things that we're teaching, do they actually work? And so I actually built a very successful institutional business around, quantitative research that we've developed in academia. And since then, I've taken the institutional business and also created retail vehicles. So now all of our strategies are available in active ETFs.
So, I always like to ask before you get into the business, what kind of hobbies you like to get into when you're outside of work and you're not, behind the desk.
I guess, my hobby is watching basketball games. I actually played in high school and played a little bit in college. I went to Caltech, so it's not hard to play collegiate basketball at Caltech. And basically, if you had legs, you could play. But I love basketball. Grew up on, the Lakers versus the Celtics, right? The days of Magic Johnson and Larry Bird. So that's my passion.
No, that's great. That's what we were just talking before we got on the show, basketball and hockey. Well, did basketball playoffs start yet, or is it just hockey right now?
No, it's game two already.
Okay,
Yeah,
happens fast. We
happens
don't.
fast.
So I'm in Pittsburgh. We don't have a basketball team, but at least we have the rest of the sports. So
You got
I
the
guess I'll.
Penguins.
Yeah, we have the Penguins. So let's talk about Rayliant, right? We know you have a handful of ETFs. We're going to talk about a few of those today. But can you talk about some of the other things you do and how you're helping clients kind of holistically, other than just in the ETF space?
Well, absolutely. So, as I mentioned, we are primarily institutional. So, we run money for the governments of Japan, Taiwan, Canada. We run pension funds as well as sovereign wealth funds. So, that's kind of our primary client segment up until recently. And so, in the wealth space, in kind of the retail financial advisor space, we now offer model portfolios containing ETFs or direct stocks in the model portfolios. And of course, we also manufacture the tools, which are some of the ETFs that aren't as available in terms of the universe of ETFs. So you'll see that we are coming to markets with, sort of nichier active ETFs in emerging markets, emerging ex-China, China, and now Japan.
Yeah, so you started the business, if I read correctly, in 2016. Yeah, you guys have a significant amount of AUA. I'm assuming a lot of that's driven by your institutional work. You have a lot of different channels. Can you talk about really what made you start the business? I know you came from academia, and eventually how you kind of scaled it to where you got it today.
Yeah, so we actually spun out of a larger organization. So when I first spun out of academia and launched my funds management business, my first startup is Research Affiliates. So I co-founded that firm with Rob Arnott, built out this franchise, the RAFI, or Fundamental Index franchise, and then had my second spin out in 2016, basically spun out of Research Affiliates and kind of taken over what was Research Affiliates Asia, and kind of from that platform started offering institutional services primarily in niche markets like emerging Asia and single country, I would say Asian economies. And then, I think broadening that out since then.
Yeah, so I saw the word quantamental a lot on the website. I'm a big fan of this type of investing. We have a lot of financial advisors that listen to the show. So, can you talk about what that means to your firm in particular and how you're implementing it?
So I would say, even though I am quantitative in my DNA, it doesn't mean black box, right? I have tremendous amount of respect for stock pickers, for people who are qualitative, fundamental, but really deep dive stock pickers. And in fact, a lot of what we're trying to do using the quantitative methods is, what can we model what a really experienced stock picker actually do day in, day out basis? Just do it systematically, take out the human emotions and human biases. And of course, with machines, you can broadly apply the same methodology to, a universe of 10,000, 20,000 global stocks. So that's kind of how I think about the right way to do quantitative analysis, is to really use systematic computer science methodology to, as much as possible, replicate what a human portfolio manager and human analyst can do. But of course, we also want to, hire experienced human portfolio managers who then will look at the output of the computer, not just blindly trust the machine, but make sure that there's a layer of sanity check or a layer of risk management, especially risk managing against events that don't currently live in the data, right? Because there are just a lot of new events that we're facing right now that you can't honestly say, oh, that's happened historically, so we have some data to guide us.
Yeah, and so you kind of answered my next question, which is how much human interaction goes in it. I mean, we run a systematic and quantitative portfolio. We don't put a lot of human overlay on it, other than some guardrails for it. So it sounds like to me, and please correct me if I'm wrong, if you're kind of having humans almost fact check the model in a way that you kind of know what's coming on the horizon and whether or not a certain investment or a certain amount of risk may or may not be necessary.
I think guardrail is the perfect word for it. Because what you don't want is you don't want the human to come in and say, oh, I disagree with the machine. I have some other insights I want to implement, right? Because, the thesis is we believe in the human insight and the human framework, and we have done as much as we can using models to replicate that. So I think the human's role in this case is to say, look, if the human insights live there, let's make sure the output matches that insight, that you don't have unexplainable trades or large concentrated positions that you can't really map back to that intuition.
Yeah. So let's talk about, you have four ETFs that I've seen come to market. We want to talk about RAYJ, which is RAYJ, which is your Japan equity ETF. So if you could, can you please just explain the strategy at a very high level and what it's trying to accomplish?
Sure, and obviously Ray J is Rayliant Japan. Sounds like Raymond James, but
Yeah.
it's actually in collaboration with one of the largest financial institutions in Japan. So it's in collaboration with the Sumitomo Group. Of course, they're the largest insurance, banking, investment management conglomerate in Japan. So partnering with them is really what I think the ideal combination of taking the quantitative science and the fundamental, because they're a big stock picker shop. They obviously been in business for as long as I think the Japanese stock market's been available. And so we are working with their portfolio managers to take what we think is a more interesting segment of Japan that people don't talk about. It's really the small mid cap segment. Now, occasionally we'll have larger cap names, but primarily the focus in the small mid cap segment. They offer their deep fundamental research, and we give to them the quantitative scoring of the stocks. And it's really the combination of the two that then results in the final portfolio. So it's a very unique beta, right? Most people think of Japan as, buying things that's in the Nikkei, or buying things that are the Toyotas, the Sumitomo, the Nomuras. Instead, we're looking at a segment where you kind of rarely come into contact with these smaller names. They just aren't globally covered by analysts.
Yeah. So I definitely want to talk about kind of that screening process. I see the fund is fairly concentrated. So I looked at the fact sheet, at least the last fact sheet shows about 30 names in the portfolio. Can you talk about that screening process? I know you touched on it there a little bit, but maybe how you're getting to that, to those 30 names. And then afterwards, we'll talk about kind of how you make weighting decisions around those names.
Yeah, so the screens that we apply broadly fall into, I would say, three distinct categories, and within each categories, they're sort of separate dimensions. So the three distinct categories is we clearly focus on the fundamental. So we care a lot about so healthy, high quality fundamental, growth oriented fundamental. There's another category that's really about what the corporate insiders are doing and what you can infer from that. So it's think of it as the governance structure. Think of it as are the insiders buying. Think of it, has there been evidence of insider manipulating, managing earnings aggressively? So those could all be sort of negative and positive signals that come into it. That comes from analyzing the insiders. And then the final piece is really understanding the market sentiment. And the Japanese market is actually still very retail oriented. About 35% of their trades is retail. So it's a fairly retail influence market. So we want to understand the what flows is conducted by the institutions, what flows conducted by retail. Retail tends to lose over time, so we certainly don't want to be trading in the same direction. We want to understand what the sentiment is generally more positive, negative. So again, if there's a cheap value stock, you don't want to be catching a falling knife if negative sentiment is strong, and you want to wait and see if there's sort of catalysts around a particular theme we're interested in. So these are the three distinct screening dimensions. And I would say on the fundamental side, what's particularly important is, growth as a key, I would say, quality screen that we look at, because we were less interested in just buying a big dividend payer. We're interested in really accessing growth, especially we think Japanese recovery is for real. We want to have that growth exposure, the higher beta exposure. So quality as a screen, valuation as a screen are key. Right? We want to buy growth at a reasonable price, and then you overlap on top of that sentiment to make sure that you're kind of at the right part of that growth curve. You don't have to wait years before the growth catalyst comes around.
Right. No, I definitely want to talk about more about market sentiment and how you're analyzing that. But as far as now, in my opinion, if you kind of just look at international historically compared to U.S. equities, I mean, you'd have to be excited about the growth projections and almost a reversion to the mean in terms of valuation in those sectors. You guys of the same belief?
Absolutely. So, and this is why we actually like emerging markets a lot. And in this case, I almost would say, Japan has for a very long time behaved like emerging market, right? It's always fairly cheap, right? You want the growth story, but it seems to be much more cyclical than structurally growing. But if you now look at, I would say, from a cyclical perspective, it's probably at the cyclical trough. It's been cheap for a long time. If you look at kind of the growth trajectory, there are a lot of catalysts to believe in a structural recovery in Japan. And so this is why we really like Japan right now and are bringing a product to market, right? It's cheap, it's at cyclical bottom, but the growth catalyst seems so obvious with the really ultra cheap yen, with finally inflation coming back to that economy so they can normalize their interest rate, and households as a result of that are receiving a strong income to their bank deposit and to their network. So these are all really positive catalysts for that market.
Yeah, no, I would agree. So it's an exciting time to have this particular product in the market. Let's go back to sentiment because I'm interested, right? How are you observing sentiment? Are you looking at flows? Are you using I've talked to some managers that are using AI models to read sentiment on social. There's many different ways. So primarily, how are you trying to uncover where that retail and or institutional sentiment is?
Yeah, so I think sentiment is one area where the quantitative approach has an enormous advantage, because you could use AI to process text, and from there just score whether media and headlines tend to be more growth oriented, more positive sentiment. Also, you could use that to look at tick by tick data and understand whether you're seeing sort of retail order flows that tends to be sentiment chasing, that tends to react and amplify positive sentiments. And so we're using data and the machine learning methodology to access sentiment measures across all channels where there's data available.
Yeah. So with that, let's talk about weighting decisions, right? It is a fairly concentrated portfolio. It's not run equal weight. So when you're running and looking at certain weighting decisions, is that primarily driven by that market sentiment, or are there other things that you're looking at to kind of derive, the amount of risk you're willing to take in any single one of those names?
I would say the primary weighting decisions are driven actually by of the three buckets I talked about, it's primarily driven by the fundamental bucket that has the largest weight. Let's say that actually has 2/3 of the weight, because you want to anchor the portfolio in something you can believe in, that you want to hold for the next 5 years, the next 10 years, right? We would never get into a company that has poor fundamental just because the sentiment is positive, because that's a bit of a Ponzi scheme, right? You might trade perfectly and get out before things blow up, but I think that's not how our investors want to invest. It's certainly not how we want to invest. So for us, it's about, we want to buy companies that have the right fundamental characteristics when it comes to growth, when it comes to other sort of quality aspect to it. We want the sentiment to be there so that, oftentimes, you can be in a really good fundamental company that remains undiscovered for years, right? And then that's just a poor use of capital. So we do want the sentiment to be there, and as a way to sort of ramp us up, because there are generally a lot of interesting companies that we would like to own. the one that has positive sentiment is the one that's more likely to immediately generate return. So really, the anchor is the fundamental quality of the company. And I would say the sentiments, what the corporate insiders are doing, becomes catalyst that just predicts a faster return to capital.
Got it. So how often are you rebalancing the underlying, or is the fund purely active and you can kind of rebalance it at any time? I mean, how often or is there a, a monthly, quarterly, weekly rebalance schedule? And on top of that, how often are you kind of rerunning the fundamentals and looking at the screen to add or delete any names that might be in the portfolio?
Yeah. The fund is truly active. So there's not a sort of deterministic, like, oh, every month or every quarter we do something. As information comes through, we'll be making, rebalancing and making trades. Now, of course, a lot of the quantitative signals tend to be more, on the cycle, right? Monthly cycle for some of the data, quarterly cycle for a lot of the sort of fundamental earnings related data. So there is a updating cycle that produces a new set of screens and scores. But then remember, that goes to the active managers in Japan who use that as part of the decision criteria to put together a portfolio. And they have sort of ongoing monitoring of news, of reviewing with the actual company in terms of manager visits that then all result in the final portfolio. So I would say trading can occur at any point in time. Some of the information is a bit more, I would say, chunky as they get released every quarter.
So last question on kind of the underlying holdings and weighting, do you have any guardrails on sector exposure, or can you really go anywhere in terms of, the names that you want to put in here? Like, do you have any guardrails around you need so much exposure to financials or information technology, or can you really just take this anywhere and find the best ideas?
We have some guardrail, but those guardrail are very loose because we do believe in, look, the underlying benchmark has these sector weights. Now, do they make any sense? Is there a reason why finances has to be, 20+% for Japan simply because they have these big old financial dinosaurs, right? So for us, we want to take active deviations against what's in the cap weighted benchmark. I've always been a big believer in that. Especially in the market where you can't, say, oh, the passive index is perfectly efficient. So we do take quite a bit of deviation in the active Japan product, which is why it's more concentrated, reflecting the fact that it is also a more inefficient market, a market where the underlying index is dominated by, I would say, firms that haven't grown and firms that probably aren't going to be the one that delivers future returns.
Yeah. So as a model portfolio builder yourself, or as somebody that you're talking to, an advisor group that might have their own model portfolios, where would you put RAYJ as a allocation? Kind of what bucket would you put it in? How would you weight it? Just kind of best practices to use the fund.
Yeah, so definitely this goes into your kind of international developed bucket. And we've been telling a lot of clients, like, within your IFA bucket, right, your international ex-US bucket, frankly, when you look at what's available there and the thesis, you're probably not too excited, right? Is it the UK, which is still probably struggling with the Brexit? And I think, the pound, the inflation, the inability to raise rate like we did in the US to fight off inflation. Eurozone isn't, I think, any better versus the UK. So in some ways, if you're looking at international ex-US, I actually like Japan more than anything else, right? It's cheaper. It's got that growth story. It loves inflation, wants inflation, rather than it's trying to fight it or it's being harmed by it, right? So it has a almost opposite macro of the rest of IFA. So I would underweight within my international portfolio Europe and meaningfully overweight Japan. I would almost make it 50-50, right? Japan might be, say, 20% maybe close to 30% of IFA, but I would definitely probably bring that up to closer to 50% and then downweight Europe.
Got it. Makes sense to me. So as a new fund, or I should say, as a new issue that you guys have out there, I always like to ask how you think about marketing the fund. Right, it's one thing to come up with the idea, do all of the work, and produce good results for your clients and those who use it. But how are you guys thinking about marketing and getting RAYJ out there and people starting to implement it in their portfolios?
First of all, I'm going to go on every single podcast interview wearing a Hello Kitty T-shirt. Look, I mean, everyone knows Hello Kitty, right? We probably know Hello Kitty as much as we know, Toyota Prius. But how do you access Toyota Prius? You buy Toyota, right? It's one of the largest cap name. But how would you access Hello Kitty? You probably don't know the company that owns the brand and licensing right. And it's a fast-growing, very interesting, mid-cap company in Japan. So. No, we're out there talking to all the advisors. We are at different conferences, making sure people understand kind of our brand energy, what we're bringing to market, right? It tends to be some niche, interesting growth markets that people don't talk about, that perhaps is more blue ocean than red ocean in terms of competition. And we do a lot of, I would say, investor education, advisor education, just helping people to understand how does Japan make sense, right? How does, say, China make sense in your portfolio? How does emerging ex-China make sense in your portfolio? So these are sort of niche topics, one where there isn't a lot of education, but one I think we excel in terms of helping advisors understand where to put this in a model portfolio.
Yeah. Well, Jason, I really appreciate your time. This was a lot of fun. Before I let you go, where can people learn more about this fund? Where can they learn more about your firm and get some of that information that you were talking about?
Absolutely. So first of all, please do find me on LinkedIn. That is the primary social media platform that I use and my firm use. So go on LinkedIn, find me and add me as your connection, and then add my newsletter, The Bridge. And the idea is to bridge these less familiar markets with the U.S. advisors. So you have a steady source of both op-ed and research pieces coming from my firm. And then go to funds.rayliant.com to get the prospectus for our different ETFs.
Well, again, thank you so much. I hope to see you on the conference trail, and I really appreciate your time in doing this.
Thanks, Brad.